Welcome back to the Ascent podcast. Over the last 3 episodes, we've covered education, we've covered rising gen, we've covered philanthropy, and we're going to drill down a little bit further on this episode. We're going to talk about using investing as a tool. Investments are really what most wealth managers do, but they don't take that to the next level and say to a rising gen or even to a Gen 1, here's how you can learn through investing. I've got 2 of my esteemed colleagues with me today, Jimmy Magarelli and Tom Thiegs. Jimmy is a managing director of investments, and Tom is a managing director of leadership and legacy. Jimmy, tell us a little bit about yourself.
Sure. Yeah. Thanks for inviting me. I've been with Ascent now for 10 years. I've spent 20 years in the investment management world. Previously, I worked for a number of different institutions in New York City. But I've always spent my entire career managing money for wealthy families. So over that course of that time, I've seen a lot of things, met a lot of people. There's a lot of different dynamics at play when you meet with different families and how they think about their wealth. So it's been a very rewarding experience.
And you and I have something in common because we went through the gauntlet of the CFA.
We did, yes, we did.
It took me 4 years to get through the 3-year program. You get through straight away?
I got through pretty quick, yeah. But
thanks for showing
I don't like to
on
brag
that.
about that.
That's all right. It took me 4 years to get through the 3 years. That's all good.
Yeah.
I also had a bonus year in college, but that's all good.
Yeah, it's okay.
Tom, tell me about yourself.
I'm just thinking about the bonus year you had in college. I want to know what that was about. But no, so I'm.
It's a victory lap is what we call it.
A victory lap. I like it. I don't have the same type of financial credentials as the two of you, but I've been a financial and family educator for 20 years. I run Ascent's family education programs, and we use investments a lot to teach on that. And oddly enough, I used to be licensed, securities licensed, and do financial education workshops as one of the first things in my career. So
I 7 or what were you?
Series 6 and 26.
6 and 26.
Supervisory, yeah. Yeah, so I did workshops a long time ago, and I've forgotten most of that, I'll be honest, so I'm relying on Jimmy.
Forgot about it when you walked out of the exam room.
Exactly. But I hope I can contribute to today's conversation about using education.
I have every confidence you will. All right, so let's go. Let's dig into some foundational questions, which is how that's pronounced in English. As you look through the investment lens, why does preparing the next generation, why is it so important? What does it mean so much to families as they go through time?
Well, you mentioned it, that a lot of wealth managers, their primary role is to manage investments and manage money, right? And so it's important for the people that are asking others to do that for them to at least know a baseline level of what do my investments do? What are they doing with my money? Where is it? What are the terms that they're using? And so I think just even at a realistic level, to be able to understand the meetings that you're likely to be in, you need to have some level of financial education and investment education. So that's one reason it's important. Another reason that it's important is it helps families not be taken advantage of. And I don't think that that's necessarily prevalent, but it can happen where someone doesn't necessarily have their best interest at heart. And the more you arm yourself with an understanding of what good investment management looks like, the less likely someone is able to take advantage of you.
And Jimmy, what have you seen in your career?
Yeah, so we speak the same language as investors, right? And one of the things that's central and sort of really paramount for these families is this concept of compounding growth, right? And the main ingredient in compounding growth is historical track record or time, right? And so as you think about getting these new, this next gen involved in the wealth that they're going to ultimately inherit or control, it's reframing the conversation around time and taking a longer term viewpoint. So that's something I think that is central to all of these successful mandates, is getting people bought in on this concept that they need to think long term and think about the concept of compounding investment returns over time.
I think that's a really good point about the clients that we serve, because typically in the ultra high net worth world, we have a longer time horizon. It is generational. It's not, hey, I'm trying to build a portfolio for my retirement and for me to consume later. And I think that's a distinction that I would make. A lot of the financial education that you're going to find out in the world online, or if you go to websites that do financial or investment education, you're going to see stuff focused on, I think, primarily on retirement savings and growth. And that time horizon is just different if you're thinking about generational wealth, if you're thinking about 2 and 3 generations out, and the concepts are different. The goals can be different. And again, I don't want to put words in your mouth when you're working with these families, but I think that's something that I look to as a challenge for a lot of families to find good education, because they might even risk profiles, right? If you're thinking about what's my risk profile and what does that look like, should I be aligning with the popular sentiment out there? Well, maybe not, because if you're ultra high net worth, you don't necessarily fit into that same mold.
Yeah, one of the exercises that we take a lot of families through is this concept about an investment policy statement. You'd be shocked at how many families don't go through this process, but it reorients the entire conversation around long term, around strategy, not around picking things just sort of, what's the flavor of the day, what's been on CNBC recently, what's the news headline, and how should we be reacting to that, but reframing the conversation around long term and multi-generational.
And most of what we see in the marketplace is going to be save for a house, deplete, save for college education for your kids, deplete, right. Save for retirement, spend down. Yep. Mm-hmm. It's not about you've got this big corpus, for lack of a better word, that will be into perpetuity. And so how do you maximize that? As I look back to 2025, and when we had Liberation Day, the market sold way off. And if you're not really focused on the long term, and that is a potential opportunity, it could be pretty frightening. Yeah. So I think your part of framing it on a time basis is actually really helpful, because stock markets generally go up. Yeah. But there's going to be an air pocket every now and again. And the investment axiom is buy low, sell high. Well, most people do the exact opposite because they get scared.
Yep. And that's why the most recent, Nobel Prize laureates are all winning it in financial psychology and things like that, behavioral finance. They're learning that people are hardwired to be really bad investors. Mm-hmm. And so you need that shepherd, you need the advisor, you need the guidelines in order to keep you from making those bad mistakes. Because to your point, right, April of 2025, the markets were down peak to trough over 20%, but they rebounded back very, very quickly. And so if you miss that timing, and this happens over and over again, if you react too quickly and you miss that opportunity, now you have to figure out how to get back, and you're sitting in cash, or you're not making the right long-term decisions.
Yeah, and that time frame is that framing is very important. Mm-hmm. So what role does formal education play in investing? I mean, how do you get families to go down that road, and what role should it play?
Yeah, so let's first talk about formal versus informal. So formal education is typically classroom type education, even getting a degree in finance or something like that. That's formal education. But in the family wealth context, it's also getting together and learning from experts like Jimmy in a family meeting, saying, hey, today we're going to learn about risk tolerance, or we're going to learn about the differences between stocks, bonds, and the different types of bonds that are out there because you have these in your portfolio. So that's formal education. And I think formal education should absolutely be part of any ultra high net worth family enterprise's plan, to say we need them to know these concepts, because we have quarterly meetings that have all of these sheets of information. And if you know 2% of what's on that sheet, the meeting's not going to be valuable to you. So you need to have at least some formal education in what we have indexes, right? We have benchmarks. Well, what's a benchmark? I see this Russell 5000 benchmark on my worksheet, on my report here. If I don't know what that means, I can't ask good questions about it. I can't have a real dialogue with my advisors about it. And so formal education is very important. Informal education is also important. I think you said, what role should formal education play? It should be part of every family's plan. Informal education should also be woven in to any wealthy family's process. And what I mean by informal education is learning from conversations. So what's your philosophy on investing? You talked about the build and then spend down or consume it. And that's very different than our job is to steward. So what does that mean to steward our money? That's absolutely going to impact your investment decisions. It's going to impact the type of conversations you're having about what you have to spend versus what you're trying to leave illiquid. And so I think all of those things play a role. Formal education gets you in the game, and then informal education refines that.
Because you can learn from a textbook not to panic. You've got to actually feel the panic and not panic before you actually know what you're doing.
Can I digress a little bit? Because something Jimmy said made me think about myself. You've got this, and it's informal education for me. You said we are the psychology of money. We're hardwired to be not investors. Not great investors.
Yeah.
I still self-manage one portion of my own portfolio, and it never performs as well as other parts of my portfolio. But I need that for my informal education to teach me that lesson, to say, hey, this is valuable to listen to others. I think that's helpful education. Now, that's not formal. It's informal, but I'm not going to learn that from a textbook that, hey, maybe I'm not as good as these other experts. And so I've learned that lesson the hard way multiple times. I still keep learning it.
Even the experts underperform most of the time.
It does happen.
It does happen. Yeah.
But we've seen that a lot, and I think it's healthy if you have to manage 5% or whatever that number is, that small percentage, and you give the other 95% to a professional advisor, and you listen to what they're saying, then that's success, right? Because you're having success in that vein. So I wouldn't say, don't begrudge yourself too much on.
I'm learning life lessons here. I mean, it's totally worth the investment.
Well, and that's, in my opinion, this topic's around investment education. The formal stuff is one thing, right? You can go get your CFA, but I don't think it's necessary, right? You don't need to go and become an expert or a money manager in order to do this. But you do need some, basic level of understanding. I think the real experience comes from, or the real knowledge comes from experience, right? I use this analogy where, when you're teaching your young kid to learn to drive, right? We all went through this process when we were teenagers, and most of the time, this is really what we're talking about. We're talking about bringing up a teenager or a young adult, and starting to instill these values and beliefs and understandings to them. But you go and you get your written test and you take your exam. You're not a driver yet, right? The real experience and the real knowledge comes from getting behind the wheel with an instructor, with quote unquote an advisor.
You're a pilot, same thing, right?
Yeah, same thing, right? You go up and you get behind. You don't take your written and go fly. You learn to fly with an instructor, with a professional. And that's the safe space where if you get into real trouble, you have someone that can rescue you or get you out of that trouble quickly. They can see the potholes coming. They can see the issues coming ahead, but it allows you to really get that experience. So I love that analogy because I think it goes for investing too, right? Get your hands in there, right? You don't need to have all the formulas figured out in your head before you start investing.
So that would be traditional blended with experience. Get in there and learn, get book smart, but then get real world smart.
Yeah, book smart to a degree. I mean, you have to understand the difference between debt and equity and those basic concepts. But do you need to have a DCF model build out or something like that? Something really
discounted cash flow.
Yeah,
Thank you.
Exactly. Yes. So that's the part where I think people stumble because they feel like they need to be an expert.
Okay, got it. Got it. So let's shift specifically to investing. Not just as a financial mechanism, but how do you specifically use that to help younger people or even people who are just not familiar with investing make that first step in the journey and then continue along that path?
Yeah, I'll start. I have shared a little bit about this in a previous podcast, and I've had my son have his own investment account, and my daughter actually, she has not jumped in as deep as he has, but since they were 11 years old. And he's 15 now, and he knows a ton about investing that I never thought he would have known. And that was just giving him a platform. And so I think giving them this ability to be part of that world and gain comfort and learn and grow, I feel like that's a great way to do this for families. Jimmy probably will talk more about sandbox portfolios that's playing in the sandbox. Usually these are it doesn't necessarily align with the analogy of flying because that's probably high risk to do it on your own. I'm talking about lower amounts of money where if it did go down significantly, it's not going to make a massive difference in your lives. And so allocating a certain amount of funds that you're fine with them playing around with, there will be a lot of good lessons learned. One of my favorite lessons that my son learned was losing 98% of an investment he made because he got a tip from someone and listened to that tip, and they said it's going to be huge. And he put the largest chunk, it wasn't a huge amount of money, but the largest chunk of his investment career so far into that one, and lost 98%. And that lesson didn't cost us a ton of money, but it taught him something really, really valuable. That, wow, this can go away if I'm not smart about it. And maybe everyone doesn't have good tips. And so all those
Tips
things
are not an investment thesis.
yeah.
Yes.
So just giving them the ability to play around in that sandbox is going to pay dividends. The one caveat is don't put a ton of money in there that you're not willing to lose. Yeah. I feel like
Blue Horseshoe loves Endicott Steel for those of us who are
Yes.
Wall Street movie fans.
Wall Street
Yep.
movie. Yes.
Exactly.
Yeah.
So
Yeah.
sandboxes, that's kind of your
the
thing.
sandbox portfolio, right? And it's just as the name suggests, it's a safe space for you to build and explore.
Is
and
the sandbox funded or is it
Yeah,
paper?
no, it's funded. It's
Funded,
not
okay.
paper money, and it's important that it is actual money and it has actual implications. We just don't want to bet, the farm here. We're trying to have this be an experience, much like it's the driver's education, right? You want there to be a little bit of, risk on there because that's how you actually learn. But it has to be measured appropriately. And that's where they get to really form their investment thesis, make decisions, and then most importantly, they get to recognize the repercussions and the consequences of those decisions. It's important also to do the sort of post-mortem, right? What worked well, what didn't, and why, right? And explore those things, because that's how you really get to the light bulbs start clicking when people see, oh, I made that decision. And was it luck? No, I actually thought that this was going to happen. And this played out this way. Right.
So everything sounds great, except this isn't something, if somebody's been head down on a manufacturing company for 30 years and they sold and now they have a nice fortune, who's going to educate that kid? Who does that kid or rising gen talk to? Because you're not talking about, advanced stuff, but you're talking about, hey, you need an investment thesis. Sure. Oh, I don't even know what an investment thesis is. How does that get into that part of the learning process? I mean, it almost sounds like they almost have to have some kind of an advisor if there's not an expert within the firm.
Yeah, that would be my suggestion. Would be engage with somebody who does this and has been through this process before, right? And that's something that we do obviously here, but there's lots of different people that if you trust someone and they are competent and they've done this before, it can be a great learning tool. But yeah, you do need a shepherd, especially when you're first starting out.
Okay, talk a little bit about investment committees, because I've been on investment committees my entire career, and it's a different dynamic than coming up with an investment thesis, putting some money to work.
Well, but that's still a part of it, right?
Sure.
Is the committee just means that now you have to convince other people that your idea is the right one. And that's what we spend a lot of our time doing here every day, is making sure that clients understand that we're making the right decisions for them. But it teaches a lot of resiliency. It teaches, and don't back away from conflict, right? If you ask 10 different portfolio managers what to do with $1 million right now, you'd probably get 10 different answers. Or more. Right. And so the theory here is there's no right answer necessarily. I mean, in hindsight, there always is, but you don't know going in. Nobody has a crystal ball. So you have to make good decisions, or at least defensible decisions. Have an idea and then be open to the idea that that's wrong. Have conversations. But you would be amazed at watching someone go through a process where they identify an investment theme, they defend it, then they transition that theme, and ultimately it either works or it doesn't work. And the growth and the education that comes along with that experience is wonderful. So
this is where family communication sort of intersects this too, because I've worked with a lot of families on this and been in those rooms where they're having these discussions, and there is a major difference between the families that have good, healthy communication patterns and they're able to handle conflict. And if Jimmy, you and I are on this committee, let's say, and you disagree with me, I don't take that as a personal affront. No. I think that's why you want to work on I wouldn't just have an investment committee or do investment education and not do other interpersonal education on communication, because you're going to create more conflict, because those committees in particular, they're designed to have disagreement and dialogue about different perspectives. And so you're going to run into that need to have conversations where we come together, where we figure out either compromise or figuring out, okay, you get this one, I get this one, or even something cohesive. And so I really think that you need to pair the interpersonal communication education along with, especially if you're diving into investment committees, because there's different roads there.
Yeah.
Well, if there's unanimity, it's probably the wrong investment.
Yeah.
That's just kind of the way our world works. So how do families decide what level of risk they should take on or in these sandbox or learning portfolios?
Okay,
I'll take it.
So I'll start, and then,
go
and then
for it.
you can start, because you're going to have a probably a more technical answer.
That's okay.
I like when we do have these smaller sandbox portfolios that are managed by individuals, that they get to have their own risk in that and see what happens as a result. And because then they come to that broader conversation with more information, that, oh, wow, I had a higher risk one and mine went down, and maybe that isn't the right idea, but you started out thinking it was, or vice versa. And so I like some individuals to have their own fingerprint on some risk, whether it's their own portfolios or something you do together. And then together, I think it's hard to determine we all agree on this risk level. And I think too often families will say, okay, we just compromise and take there's 5 of you who like a little bit more risk. There's 5 of you who want we're going to be in the middle. That might not be the right answer. And so I think it's a more complicated question of bringing in other voices. You can probably get more consensus, not just from the individuals in the room, but maybe the industry or additional advisors to make sure they're making the right call.
Yeah. I'm reminded of the story you just told about your son, and the position went down 98%. And
it's a good learning lesson.
It is a good learning lesson, right? And that was probably very valuable. And was it the only position that he owned in the portfolio? I'm just curious.
Oh, no. He owned a bunch of others.
Okay.
Yeah.
Yeah. So, I mean, risk can take a number of different dimensions. I would say diversification is an important one too. So having people come up with multiple ideas, right?
I'll say 40% of his eggs were in that basket.
Okay,
though.
that's a lot.
So
that's
that's why I said it was the
concentration.
largest one. So
anything
it was
over
Actually,
10%.
4% of his eggs were in that basket at the end of it.
Yes,
Yeah.
exactly. Yep.
But I mean, that's a lot. That's a side concentration. I think a concentration anything over 10% that isn't diversified,
Nope.
right? So, through that lens, I would say having people come up with multiple ideas and having multiple different avenues for return when they're trying to construct this little sandbox portfolio is going to help mitigate some of that. But then the experience again is part of it. So you get your hand burned and you realize, oh, maybe I shouldn't have made that decision, or what went wrong there? Well, I had 40% of my portfolio in something that I had no understanding of. That's a coachable teaching moment right there for sure.
Yeah. One thing that does happen sometimes when we're talking to families about this, or they're trying to navigate this issue where they have differing views on risk, is I think they agree on the end result often. We all want this end result.
Sure.
And so they're focusing on the path there that they disagree on. Oh, I don't think this will get us there. And so going back to what's our end goal?
Yeah.
What do we think will get us there? And some people are like, well, no, it's going to be this risk profile that gets us there, this risk profile. But at least you agree on where you want to go.
Sure.
So I think that's something to think about. Yeah.
Yeah.
Especially if you're at an impasse where, you're saying, well, we disagree. Let's broaden this view and say, what's our overall goal? Well, we all want to make sure this sustains, or we're stewards, as you've brought up before.
So this is specifically for you and it's hard for Jimmy and I to fathom this, but what if somebody in the next generation who you're trying to engage with this just flat out doesn't care? Now, we've been lifelong investors, so of course we can't imagine anybody would not be interested in investing.
How dare they, right?
But for those that aren't, how do you approach that?
Yeah. I actually think I was being a little facetious when I said, how dare they? I don't know if it's a necessity that you become an expert even if your family is managing a lot of funds. If you are the type of person, we work with a lot of people who are like that, a lot of clients who say, I trust you. I know that you have my best interest at heart, and I don't know a lot about this. I don't need to. So trying to keep
it should never go down.
Yeah. Well, never. Well, okay. But I think I mentioned on the top end of this that you need at least some baseline. I agree with that. You need something so that you know that the advice you're getting isn't, totally off the wall. But other than that, I don't know if I would force people. Force feeding education is never going to work.
It seems though if somebody's going to be a good steward, which has kind of been pervasive throughout our conversations, they need to be able to ask the right questions and recognize when it doesn't feel or smell right.
Yeah. So then
that's kind of the baseline you're talking about.
In that case, yeah, if they're not even invested in, pun intended, learning about the baseline to be able to ask good questions, and you say, no, you need to have this understanding, I would try to hook into what they are motivated by. What is it that you want out of this process? Do you want to just be hands off and get distributions? Because if that's the case, we require a certain level of engagement to get distributions or something like that, right? Try to connect to their motivations in some way, but also be realistic about not expecting everyone to become an expert.
Yeah.
And I guess I wouldn't say expert, but if I'm going to be a good steward, I need to have some sense of fiduciariness, which is a new word, to this, because otherwise, I'm just letting somebody else do it. And that may not be unless they just offload that to another part of the family. And because I wouldn't expect everybody to come in with a stock recommendation. That's a little beefy. Maybe it's just, hey, I don't understand how this works.
Yeah. I think the two things here is don't expect everyone to have the same mindset and the same goals. But if you do have this baseline that you want to get people to own, that their motivations might not be your motivations. So if you're trying to say, this is why it's important, and that message isn't landing, it might be that the messaging is off, not that they're disengaged. I think, and it might be that they're disengaged, but I think going there first would be a mistake. Try to look at what would engage them instead of just label them as they're just disengaged.
You can lead a horse to water.
Yeah. Yep. Exactly.
You could also, in the investment world, we talk about values-based investing, right? And I think everybody cares about something. You just have to figure out what that thing is. So maybe you have a next gen who's not necessarily interested in creating an investment thesis or bringing ideas, but they have a passion around an objective, right? We are going to help solve X. We are going to help fund Y, right? Whatever that is. And then use the investment portfolio and the education process as a tool to ultimately get that objective, right? And that could be a way to get people engaged, because there's got to be something that person is passionate about. So connect the portfolio to their passion.
So when is it a good time to start talking about wealth?
About wealth in general.
I'm sorry, about wealth, but wealth is related to investing.
Yeah. I don't think there's, maybe 5 is the earliest I would go. Younger than that, but they probably don't understand it. But I think starting at even the age of 5, Jimmy, you have some kids that are around that age. They can probably start understanding that money can grow if it's put in certain places, or we buy portions of companies that they've seen before. And so talk about it in that way. But I think you can start as early as, 5 or 6 years old. Yeah.
And a lemonade stand it's an entrepreneurial tool, but you're still generating income with these things.
Yep. What are the goals, right? And even talking about retirement and with your kids and saying, hey, at some point I would like to not have to go into the office every day. And so I am trying to grow our money so I can retire. And so those concepts are totally fine for that young age. And then as they get a little older, right, you might talk about college savings and what you're doing there and how you're trying to grow 529s or something, related to that.
Yeah, I don't think there's an age. I think it's every individual's got a different level of maturity and understanding. I've met teenagers that are very financially savvy, and I've met people who are in their midlife and they don't know anything, and that's okay, right? You meet people where they are. The big thing is eliminate the jargon. I know I just brought up the DCF model.
You did.
The dollar but the point being is trying to eliminate that stuff, because that's where people get really intimidated. They don't want to feel like spoken down to. Talk to them in real terms with real words that people can understand, and you'll get connectivity just by, simple concepts, right?
Yeah, I think investment professionals, as do lawyers and doctors, tend to use complicated words and acronyms.
We like to make ourselves feel a lot smarter
because
than
if
we
people
are.
don't understand what you're saying, obviously you're brilliant.
Right.
We talked in episode 3 a lot about using philanthropy as a development tool. If you'd like to go deeper in that for anybody who really wants to engage, I think that's something that episode 3 would be helpful for. But you talked about assigning a value or saying find something that people find a value in. Yeah. And if you have a philanthropic interest that's supported by an investment portfolio, is that kind of the tie you're thinking
That's
about?
exactly what I was talking about or referencing is, and I like to use donor advised funds for this purpose. I think that they, for those that don't know, donor advised fund is basically just a portfolio that's earmarked for charitable causes, but it's a little bit easier to administer than, call a family foundation, right? Where you have a board and you have, various governance documents and things like that. So you can create a very small portfolio, a sandbox portfolio, using a donor advised fund, which is earmarked toward a specific purpose. And now you're aligning and you're allowing that next gen to manage the portfolio, manage the investments. But now they've got some skin in the game to say, look, if they're passionate about, housing or something like that, they can invest in a way that they can benefit that passion project of theirs. And so it ties in all of these concepts, the investment education, next gen engagement and alignment with charitable causes and objectives that they really like. So that is my preferred method of teaching and shepherding them through that process of the investment policy statement, putting the appropriate risk and controls around that, concentration controls, right? Making sure you don't have 40% of your portfolio in one thing. And then the outcome is I get to benefit something I'm really passionate about.
Yeah, if somebody's really passionate about whatever their cause is, this is what you need to do to support that cause,
Right.
which is understand at least how these funds are invested.
Right.
That makes a lot of sense.
Exactly.
I actually love when we were talking about philanthropy, I mentioned connecting the investments with their causes, and I also talked about an older generation funding the giving of a younger generation. I think the individual donor advised funds is an amazing way to do that. That's a level up version of what I described, where you're also layering in this investment management aspect of it, where not only are we asking you to look for organizations and donate to them, but now we are asking you to invest your time and energy in learning about investing in the portfolio and maybe add more organizations to that. So that's a progression of what we had discussed before as what families can do to help educate their next gens, both in giving, but also in investments.
Yeah. It creates also a level of like ownership, right? And you have to own everything in this system, or you have to own the portfolio, and then you have to make the decisions about where is that money going to go and who are you benefiting and who are you directly giving that money to, and that creates another level of diligence, right?
Yep.
Who am I going to
Vertical
give?
integration.
Yeah, there you go. Yeah. More $5 words.
So as we kind of come to the close of this, education, legacy education, it's not an episode, it's an ongoing thing. It's not a picture, it's a movie. How do you think about creating that consistency over time?
I would say creating a rhythm, right? Consistency is key. So I'll give you a really silly example. My son's 6, and we're doing a lot of this learning on multiple fronts, right? He's learning mathematics and things like that. And I create a system where I pick him up every day from school. And on the ride home, we talk about what he focused on today. What was the subject matter? And he'll say, today was science. And what was the science subject? It was volcanoes. And we go through and we talk about all the lessons that he did. And I'm doing that intentionally because it's sort of like that homework thing. We're bringing it back up.
Yeah.
We're bringing it back up to the surface again so he doesn't forget it. And you create that rhythm. It's the same thing with this. talk about whether it's Friday nights, pizza night at home, we'll make sure that you're talking about what's going on in the business community, what happened in the markets that week, what happened with a particular company that you like or follow, what's happening with your portfolio. Make it organic, right? You don't want it to be forced. Have some sort of, I don't know. It's not a homework assignment. It's not meant to be a labor.
It's a conversation.
But it's a conversation, and you're bringing it up consistently over time. And then I think the other thing too is make sure that if there are any actionable items after you've had that conversation, that you're assigning authority to someone, about, hey, we just talked about this for 45 minutes. Is there anything we need to do on that information? And if so, who's going to do it? And I think once you create that feedback loop, you'll really have a lot of consistency and a lot of great growth.
Yeah.
It's funny when you talk about, I used to drop my kids off and torture them with my 1980s Name That Tune list. And they would just dislike me.
I bet they know a lot of 80s tunes.
They do now.
So
yeah,
there you
they
go.
get drilled into them. So but that's a little different than talking about volcanoes on the way home from school.
It's the same process. It
is,
works,
just,
right?
Just with very little positive impact.
And they know a lot about like Pat Benatar or something
They
that.
They absolutely do.
I'm going to add something. So if you're not lucky enough to have an expert like Jimmy in the house who can facilitate these conversations, I think we also do this in our meetings with families, whether it's a quarterly investment review or something like that. And then this is the key. You have a concept that you want to make sure everyone walks away with. And so you're layering and you're doing this. Yes, it's not every night or every week that you're talking about it, but it's quarterly. But over time, then those concepts become part of we now know this, the general knowledge of the group that's in the room. And so we like to look at, okay, so what should we highlight this meeting, right? I mentioned Russell 5000, right? Okay, what do these mean when we're comparing to these other indexes, and why are we putting them on here? Right? Okay, now everybody knows why that's on your report, and you just layer on other things after that.
Yeah,
makes sense. Well, let's kind of bring this home. If we integrate wealth into a structured learning journey, Tom, this is right up your alley. How do we create a unified, ongoing learning pathway for rising gen, actually for anybody who's interested in this?
Okay, it's a big question, but I'll do my best. I think the learning journey should at least reflect what those members are interested in initially. You need to get momentum. You need to build on that momentum. It's sort of like starting a boulder rolling. And so if you start with things that you think are important, but nobody is interested in,
there's got to be an equal sign there.
Exactly. Yeah. So I would say try to hook into their values. And that's why we gave a lot of different options, whether it's, so these people are interested in investing and that the understanding of that, or these people are more interested in giving and sharing what they're passionate about. Well, that's different than the education we were talking about. Or maybe they just want some autonomy and to invest. And we said, give them a sandbox portfolio and let them go and start there. So it does need to mirror what their goals are. And then once it gets rolling and once you get some momentum and people feel comfortable in that learning process, then you start adding things. Then you say, now we're doing a more formal workshop because this is good information for everyone. And so I would not start with formal workshops. I would start with little things that connect with their values.
Yeah. I'm going to say find a great advisor who can help you hold your hand and avoid some pitfalls. Investing is wrought with pitfalls, and the best advisors will just help you avoid those, and then shepherd you through that process, right? And whether it's the formal education piece, trying to figure out what's a stock, what's a bond, and all the other esoteric concepts, or it's walking you through the investment policy and why it's important, and helping you construct that first sandbox portfolio and getting you going. I think that's the real starting point. It's a building block. You're building a tower of blocks, and you got to start at the foundation and work your way up. And that's it's a long lifetime thing, as you know, right? I'm still learning things every single day about the investment world, and it's a lifetime of intention and attention.
I like the building blocks, especially for investment education, because there's a lot of different blocks. You
Yeah.
say, we need this, but you don't build it all in one day.
Yeah.
You're just like, today is this block. Yeah.
Yeah,
I like that one.
exactly. Yeah.
All right. Well, thank you, gentlemen. Thanks for a really good conversation. This area is super important. In fact, it's important enough that in our next series, Investing Through the Lens of Legacy, we'll be spending time with you, Kashaman, and some other folks at Ascend and in U.S. Banks Wealth Management to really talk about strategies is to reflect who our families are, what they want, protecting their legacies, expanding their reach in the world. So thank you for setting the stage. Thank you for concluding our 4 podcast series. Appreciate your time. And
Yeah.
thank you very much.